Excellent. So, very good. 4:20 here in Brazil. Pascal, what time is it again? Sorry, in California?
12:20, so midday, lunchtime.
Perfect. So, as we have many European participants, we have to be punctual. I know Brazil doesn't have that reputation necessarily, but we'll get started with the panel. So, welcome everybody. My name is Patrick Arippol. I'll be moderating this panel. And the goal here for us is for us to talk about what's changed in the SaaS funding environment. How should you think about metrics? You know, it's a brave new world out there. A lot of things are changing quite a bit. So I think there's all the more value in really plugging into people all over the world and trying to explore what are these common threads and challenges that we have ahead of us. So it's a pleasure to be here. Thanks so much for the SaaS Talk organization. I was going to get started with doing a quick intro. So quickly, myself, I'll be quicker myself. I'm just going to be helping with the Q&A. My name is Patrick Arippol. I'm currently the founder of a VC, a SaaS-focused VC for Latin America, sort of like an emergence for Latin America, so to speak, if we can use those comparisons. And basically, I'm a former founder. I did startups here, Silicon Valley, and so forth. And just by way of background, there's one specific moment, which is the post.com bubble, when it burst, the before bubble and the after bubble. And sorry, Thomas, I think we have a little bit of noise in your connection. Great, thank you. And so there's been a lot of changes, and it's interesting how quickly things changes in a moment like this. So we're going to talk a lot about that. We have the pleasure of having three panelists in this group. So we have, for a quick introduction, I'm just going to do a mentioning of who's here with us. So we have Michiel Kotting, who's the GP at Northzone, based out of Amsterdam right now. So same time zone as many participants. So thank you, Michiel. We have Pascal Dayan, if I speak that. Sorry, my French is not very good, Pascal. Principal at Storm Ventures. And we have Thomas Kroos, partner at DTCP, and he leads the European and the Israeli practices of that fund. If I could, I'd love to get started by having each of you introduce yourselves. And as part of that introduction, maybe mentioning one moment in time in your careers, be it as a founder, be it as a VC professional, when you felt a biggest change in the environment. Not to get into any depth, but just to kind of to give a color of experiences that have some similarities to the current moment that we're living through. So if we could get started, Michiel, if you could kick things off here.
Age before beauty, I guess. No, yeah. So like you, I am a former entrepreneur. Started one successful company and one failing company. And in the successful one, we had to pitch to 104 VCs before we managed to raise money. So I have hated VCs all of my life. Now I've been one for about 10 years. So that's how things go. I think probably for me, the biggest moment of change was when I did my first startup out in Palo Alto, and it was during the dot-com bubble, before and after. And I remember watching TV in San Francisco, and there was a black screen, and it said, "You used to be a 27-year-old millionaire." Black screen, now you're just 27. And just the change from 2000 to 2001 was phenomenal to see, and amazing how during the crisis, with persistence, a lot of companies came out really, really strong.
Fantastic. Thank you, Michiel. That's great to hear. Indeed. Interesting times, I think, in comparison with the current environment. Pascal, could you please introduce yourself?
Yes, absolutely. So my name is Pascal Dienne. I'm French, but I've been in the US for 18 years now. And I work for a fund. I'm in the investment team of a fund called Storm Ventures. Some founders invest only in B2B enterprise software. Most investment are in the SaaS space. And we usually lead Series A. We found ourselves investing in a couple of European companies, including Talkdesk and Algolia. which were a very good investment for us. So we're trying to do more of those. So we're trying to be the go-to-market partner for startups based in Europe, willing to expand their operation go-to-market in the US. Scary time in my career. I mean, I'm lucky because I have not really suffered before being a VC. I was in a corporation, so I haven't really been through those motions, but the fund I'm with has been around for 20 years. And when the crisis hit, it was very scary. I've been in the VC world for 3 years now to see that and then kind of try to understand what would happen. And it was refreshing to hear the partners kind of like, since they've been through 2 downturns, 2001 and 2008, to kind of help us like take the situation, with a lot of like a cool head and just like, there's going to be an end to it. We can just keep the motion going and keep looking at it. There's going to be a world of opportunity, great startups were starting during a crisis. We can talk about Uber or Airbnb. And so just kind of like, keep walking and keep trying to find good deals as an investor, just because I think there's a difference between funds that have been around for less, like that started after 2008, and funds that have been a couple roller coasters through crisis. And I think it makes a big difference for GPs. And I know maybe Michael, you would agree with that. But if you've been through one, it just makes you comfortable that there's a light at the end of the tunnel and things will get back to normal eventually.
Outstanding. Thank you very much, Pascal. Thomas, I know there's a few connection problems here. I hope your strobe light is still working. But if you could introduce yourself, that'd be fantastic.
I don't know if you can understand me.
That works.
Yes.
Yeah.
Cool. So I cannot hear you. So but at least I can hear you. You can hear me. So I'm Thomas. Yeah. Nice to meet you all. I have bad audio problems here right now. I'm a partner at DTCP. We are a global growth equity fund. We have been started this fund in 2015. Prior to that, I was an entrepreneur. I started my first company in 1994. I started 5 different companies before I accidentally became a venture capitalist. And one of the most interesting things probably was an NGO in Western Africa, which I started in 2002. I lost a lot of money, I have to admit, but I learned probably the most. And then after that, I wanted to start my next business in Germany and started working at a VC to just get access to the industry. And then I became a partner in that. And then I started 6 years later my own fund. And now we run DTCP. We are a B2B focused growth fund. We operate across 4 countries, like Germany is the headquarter. We do have an office in Menlo Park in Silicon Valley. We do have an office in Tel Aviv in Israel. And we also have a team in Seoul in South Korea. We're an independent company. So our company belongs to our employees and us partners. We are not a strategic investment fund. We are not a corporate fund. We are just a normal private equity and growth equity fund looking for investments from Series B up to Series E pre-IPO rounds. Our sweet spot is tickets between 10 and 20 million. We can go up to 100 million. And probably we would do a little bit less, like 5 million or so. So we have a big domain expertise in enterprise SaaS. Yeah, that's me in a nutshell. I pretty much look forward to discuss with you today.
Fantastic. Thank you. Thank you, Thomas. So that's great. It's great that we have a good representation here, different regions, different time zones. Also the later stage, Thomas, where you operate, as well as the earlier seeds, Series A stage, where Pascal and Michael mostly do most of their work. And it's interesting too. More and more for a lot of technologies we were speaking earlier on, things are becoming global a lot faster. So it's exciting to be living at this point in time. But frankly, I think in the beginning, and this was definitely a cycle that we felt here, when things really started changing very rapidly, everybody was trying to pick up data, trying to get an understanding for what happens. And I think from all business models, SaaS is one of the most predictable models. So it gives everybody a little more anxiety because we're trying to find our new north as founders on what's changing behavior, how should this be affecting my company, and so forth. At the same time, we know that these economic cycles, they don't all happen at once. Most of you probably have seen at least some of the numbers from the prior cycles, and there is an adjustment. There's a chaotic period. There is, there's at least 2 or 3 periods. And Michael, I was curious if you could share your views on, do we think that this is going to be, independently of trying to do a prediction on the macro dynamics? I think that's a very hard thing to do. But what would you recommend that founders think about different phases that we might see from this point up through the next couple of years?
Yeah, I think like a lot of us kind of in working with the portfolio companies in the last kind of 3 months, try to make sense of what was going on, and in sort of a more simplistic model, sitting down with them, try to kind of break it down into 3 phases, and to say there's sort of the lockdown where the world behaves really atypically. Then there's the recession where we've kind of have some historic experiences before what has kind of happened in recessions and what type of companies are recession proof or not. And then there's your next fundraise. And it's very important, especially as we have had an expansion that lasted so long as it did, where companies have been trained so much to operate on certain parameters and be used to, okay, if I double my revenue again, I can raise it about twice the valuation, to realize that investors will look at companies very differently, value top line growth a lot less, value solid unit economics a lot more. And so what we've tried to do with these companies to go through, say, hey, what do you face during lockdown? Is this disastrous for some companies because their business would have to be kind of completely shut down, to accelerating in other cases? Then what are we expecting for the next year and a half, and what does it mean on when you run out of money? And then finally, kind of what is the new north, and what are the new KPIs, and what are we building towards to be kind of safe there? And I think probably like a lot of people in the industry, we had the luck that all of us were kind of already talking about a recession before the COVID happened. So a lot of our companies were very well capitalized. So there was no immediate shock, but it doesn't mean there's not a late shock, right? And we've said to all companies, if you think about a recession in 2 phases, where early on you don't know what's happening and you might be too optimistic, and later you see how things have changed and perhaps competition is lower or customer acquisition cost is cheaper, great companies can accelerate in the second half. So rather be too aggressive in shutting stuff down or being conservative in the first bit, because you'll be spinning your wheels, and besides, everyone will forgive a slowdown. So you then have the extra capital to accelerate again in the second half, and then prepare well for what comes after.
That's great, Michael. Thanks for sharing that. And it's interesting because in the shorter term, everybody still sees a lot of volatility and changes, and bringing things closer to home, which is this moment that we're living in. What's happening right now? Because I think one of the things that, and there was an interesting report that just came out yesterday, the second edition, I think it was NFX, a group that did a survey of a lot of founders, and they figured how there's a delay sometimes in founders coming to grasp with the new situation vis-a-vis investors. Maybe that's the lack of hair or the bigger, the longer experience that we've lived through cycles. But independently, there is an aspect that I think as investors, people have to kind of really sink in the new situation fast and be adaptive as soon as possible. And I was curious, Thomas, if you could share your view on what is this issue of how quickly a company manages to hone into a new environment and really start operating in a new paradigm. Could you talk a little bit about that, please?
Yes, sure. At least I can try. So as you see here, I put some disco lights on because I want to convey the message that what I think that the party is not over. So and we to your point. So we are here in Germany. We do have a global portfolio, and we can really compare very, very good. And the markets are in different stages, and it's coming back. We do have an enterprise software portfolio, so that's mean we are not that impacted that strong from COVID, because the more technical a product is, the less impacted they are, because these installments and customer base, they will continue their projects. It's not like they immediately shut down cybersecurity, or they postpone the move towards or a cloud migration project or something like that. But we do also have a company in the travel space. So there we do see customers of theirs having a hard time these days. So we went through this with all founders and all teams and tried to tell them, look, it's raining. You need to prepare for the worst. And some of them are very cautious. Some of them are not. Some of them are just like blind, because they built everything. They put everything into the company over the last years and built just the best company in the world and the best product with the best proposition. They could not even imagine that anything goes wrong. And there we really have then to try to help them to see what can happen, because I went through 2001, I went to 2009, and now 10 years later it's happening again. And there is some certain patterns, and the good advice that we give, and I have seen that it is simply right: just act, just do something, and don't wait, because then probably you get surprised by you have burned the money, because the new ARR did not come, new customers did not come, upsell did not happen, churn increased, and then all of a sudden your money is gone. And so the crisis is an opportunity, and founders need to understand this, that they have to act. They are the captain on the ship, and they have to do. And it's better to make a mistake by probably firing too many people, and then you need to rehire some of those, other than keep all this, keep the pace, go ahead full stream, and then and then you're in a financially weak position. And this happens, and it's our job to help founders and teams through this, because we have the meta view. We can compare between different industries, and also most of us have gone through this multiple times. So there is a lot of work from a VC to be done in these times.
Thanks a lot, Thomas, and Lena. Thank you for the question. We're going to get to your question on KPIs. Actually, we want to cover mostly that topic. We briefly spoke about the environment and adapting to this new norm, so to speak. We're going to talk a little bit about fundraising, because a lot of people were interested in talking about fundraising, and we're going to talk finally about KPIs, and I think that's one of the most important things. About fundraising, I think it'd be interesting to hear all three speakers, panelists about this, and maybe starting with you, if that's okay, Pascal.
Yeah.
I mean, one difference in between the prior cycle of 2001, at least, is that after the bubble burst, you didn't know when companies were going to start thinking about technology again. I mean, if there's one thing that we know about this cycle, is the technology is going to become all the more important after this cycle. So there is some interesting, interesting dynamics taking place now. But could you mention a little bit how you see how much have valuations changed, Pascal? Valuation and criteria, have criteria changed? Are we looking at growth? Are we looking at, what's changed primarily in your view?
No, yeah, absolutely. So when we look at a company today, we need to understand, what's going to happen, and if we have to build conviction to invest. So what we look at is like traction of the company and metrics of the company pre-COVID. So anything that happened before February-ish of 2020, and try to understand what the story would have been without COVID-19. Because anything after that, it's really hard to assess. If, there's a lot of churn, is it because of COVID? Is it just because, the product is not good enough? So we're struggling with trying to really understand how to interpret the data that are presented to us post February 2020. So to do so, we kind of refocus on, so we look at our portfolio, and our portfolio is a mixed bag. Some companies are thriving, some companies are struggling. So there's a couple metrics to look at. Like one is the runway, or what we call the zero cash dates. How many How much time do you have until you run out of money? And what is your plan as you get there, right? And so that's as a consequence, which is instead of for us to focus a lot on growth, which was the case before February 2020, and we were hoping to see 20% month over month growth usually, we're now could be happy with a 5% or 10% growth month over month. But I think at the end of the day, what really matters is what is your story? How can you help us understand how is your company is adapting to the crisis, and what is your plan to get there? And so the metrics that are presented in terms of the burn, in terms of what is the plan in terms of cuts or not cuts, or maybe more professional services being done to increase the cash of the company, to help us build the conviction that the company has a line of sight of a year or so, or that with investment, the company is going to thrive in the current context.
That's fantastic. Thomas, could you maybe chime in with your views, perhaps on should founders focus on valuations? Are there other important things?
Thank you for the
about
question.
How VCs can help as well? I mean, how do you think this has changed?
Yeah, I love this question because the answer is clear. So money is not a differentiator, and so you find money at these days anywhere, especially the later you are in the phase, that the better the KPIs are. Like once you hit the Series B, the expansion stage, then there is truckloads of money. And then it's not about money, and then it also should not only because of for you around valuation. So dilution is not the most important thing. You have to consider like value which you receive, and this is also not brand names from funds. This is more around like who is joining your team, who you like. It's like with soccer. Like you need to, as a CEO, you need to manage to get the best 11 people on the field to win the game, and you need to understand that investors are part of your team. They are in your board, and you should more look at them. Who can really provide value? Who understands my industry? Who has the best context? Who is a great guy I want to work with? Like it's very important also to have fun. You as a founder, as a CEO, you did not start your company because you wanted to do a career in an enterprise. It's simply not your personality. You want to change the world. You want to have fun while working, and this is very important throughout the life cycle of your journey. And that's way more important than money and valuation. So I can only give the advice: look at the guys who really join and who really do the work, and what can they contribute, and what advice can they give you? Is it only because of raising next round and trying to sell the company highest price? No, it's around like, okay, where do I find the right talent? How do I build the organization? How do I build a sales machine which really is efficient? How do I build the marketing funnel and all that stuff? And if you find guys you really want to work, and they are a good wingman, good supporter to you, then probably give them credits for that, and optimize rather on that than on valuation and money.
That's great, Thomas, and that's a great insight. So build those relationships way ahead of time if you can, and you might want to decide to do a round even if there's a different dilution, if there's going to be a lot of addition from that investor. I think that's a great point.
Yeah, and maybe one addition. So and probably it's not always the senior guys which are the best support for your company, because sometimes like more junior guys, or really the guys who are doing the deals in the funds, they are more into they have domain expertise. They are probably ex-founders. They are developers themselves. They know the technology stack. They know all of this. Probably it's also around like the team, around partners, around the senior people in funds, who you should really look at, because these guys are the ones who really provide value and can help you with solving your real problems, and not like how to discuss nicely in a board meeting.
That's great. That's great. And still in fundraising, Michael, I would love to hear your thoughts. Let's say a founder has a startup. They have the product market fit, which has kind of been adjusted to the new behavioral changes, and the growth engine has clear indications that things are working. Should this founder do a round now? Should he or she think about valuations? Are there other considerations? As we know, many of the calls with founders and between founders and investors are remote, and many investors like to meet in person, and it's not always possible. I mean, what else would you recommend for a founder that believes that he or she has found the right fit? Is this still worthwhile time to do it? Are the funds all on their sidelines, or they're still doing deals right now? What would you recommend for this type of founder?
Well, first of all, I mean, you don't pick the time picks you, right? So dream and you're building something, you're not going to sit around and wait. You're going to raise now. And of course, in the sort of the interaction between founders and VCs, this is in certain ways a more difficult time. But on the other hand, I think that in both directions, it's a time that clarifies a lot. And if you think about, as an investor, we think about that sort of this triangle between product, market, and team, and all three kind of need to be there. And maybe on the market side, you get a lot of uncertainty and question marks now. But I would argue that on the founding team side, you get a lot more proof points. And to me, it's a little bit kind of similar to when I started out in tech. You had to raise kind of 3 million just to build a website, right? So therefore, you could only raise money based on an idea and the team that you would bring to the table. And you couldn't see any traction or product market fit before you needed to put in significant money. I think similarly, in the last kind of 10 years, with the rising tide and all the boats are floating, you couldn't see how a founder would respond to a crisis. And so you had to invest with the idea like, hey, you have great market fit, you do very well in expansion. But when, the shit hits the fan, and it always happens at some point in the development of a company, we don't know how you're going to behave. And I think right now you see amazing behavior of founders where they are so creative and they're so kind of responsive, and they manage to motivate people while firing other people at the same time. They manage to convince customers to stay with them even if there's no capital. And I think seeing that kind of really kind of feeds a lot of input from our decisions. And I think similarly with founders, I think you're now interacting with VCs. And if I look at our own portfolio companies, there's sort of two types of inbound. We are getting inbound from companies that are good, where people think, oh, they must be struggling. And everyone knocks on the door and says, hey, you just did a big round with X, fill in a big brand name. Do you want to take 2 to 3 million extra, implying that's on the same valuation? And of course, now you have to take our money because you must be with your back against the wall. Or there's these other companies, including the tool that we're using, like Hopin, right? Where people go like, oh, this must be something, which is true in this case, that does super well during a lockdown and that kind of behavioral change. And there's so much capital in the market that everyone starts chasing these opportunities that do well in this type of crisis. And I think as a founder, you get a real chance to see how VCs behave. And are they now going to string you along because they have a hard time making their decision from conviction? Are they really trying to kind of push really hard and negotiate kind of terms on you? Or is it a collaborative partner? So I hope that sort of the crisis, yes, it's much harder. You can't sit at the same table. You can't walk around in the company. You can't see that kind of stuff. But I think there's other stuff that comes up that is actually more important.
That's great. I think that covers well. It's a tough fundraising environment, to say the least, but at the same time, it's so open. There's a lot of managers, a lot of experience, a lot of people, and it's great if you're able to align first your business model so that you know how you're going to use that capital, and then work on those relationships, as to Thomas' points. So thanks for sharing that. Now let's flip into the topic that Lena, thanks, sorry for taking some time to get to that from Poland, on the KPIs. I think it'll be too ambitious to try to cover that fully in terms of what's happening today. So we're going to try to pencil in a few examples of some KPIs. We spoke before, most businesses are very predictable. So the SaaS scenario planning, usually you're looking at CAC, you're looking at conversion, you're looking at lifetime churn, and you're able to monitor and adjust your business throughout. Also, you have a huge, if you don't have if you really are a vitamin and not a medicine, as in a critical application, it can be very sensitive, very complex. So there's a lot of changes around. How do you work with that behavior? Before, if you looked at conversion rates, etc., things might be completely up in the air. As we know, all of us are living through a different mindset, so we have to adjust to that. Now, I was curious if we could go around the group here and kind of share one specific experience that you felt in this crisis, in terms of what maybe starting with you, Pascal, if you could mention first, what are the main KPIs that you felt that have become a lot more important? And after you speak about that, if you could maybe mention of one example of a surprise or a big change in a specific business model that you found in terms of KPIs.
Yeah, so for sure, the biggest KPI for us became the burn, just because it's really hard to assess the growth. Trying to build conviction on what would it be post-COVID, but the burn becomes a big part of that. So you cannot build conviction of the growth rate post-COVID, but meanwhile, you need to believe that the company will do well until the end of the crisis. So burn became a big one, and we usually, see companies, and that story you're going to tell around the burn is very important, because I see some companies coming with a couple scenarios of like, this is, how we're going to do depending on how the crisis does, and this is how we're going to reaccelerate sales and marketing as we get closer to the end, when we start seeing signals that the crisis is almost over. I mean, NASDAQ is at an all-time high at the moment, so we start seeing signals that things may be better. So we use that. We use also our portfolio companies to kind of see some deals picking up in the sales funnel, and we see some motion accelerating a little bit, so signals that it's getting better. So we combine that with the story that the companies are telling us and the metrics that present us, including the burn, to kind of like put the whole story together. So I wouldn't say it's one KPI per se. It's kind of a couple KPIs, including the burn and the growth. And then the actions that are being taken today or were taken in this first quarter to increase that runway.
That's great. That's great. And if I may just ask a question on top of that, Pascal, is what happens to a business model that still depends a lot on a very robust, very deep product investment, an AI platform, or something that is a business model that they're not there yet? I'm not sure if you invest at that stage or not, but does that change the prospect for that kind of business, that focus on bottom line?
Yeah, so we invest at Series A. We invest when there's product market fit and we see the acceleration past 1 million in ARR. So we don't really invest at that stage, but I've seen the investment in companies that are capital intensive, being hardware as a service, or as you mentioned, AI, a highly sophisticated AI. Yeah, they're taking a hit, and you really need to pitch a fund that really will believe you and is passionate about the type of product you're building.
That's very helpful. Thomas, if I think you have the disc music going there. No, I'm just kidding. But please, if you could chime in with your views on important KPIs that have changed, maybe an example, that'd be great.
For sure. So typically we look at the traditional SaaS metrics. So, and we as more later stage investors, so we do have the luck that we do have like 6 to 8 quarters of data, because we invest in Series B and the data, so we can look at it basically. So it's good for us. If you invest earlier, then it's the data is not that reliable. So typically we look at efficiencies, sales and marketing efficiencies we call it the magic number, is super important. Cash efficiency since inceptions and trailing 12 months it's very important for us. Good indicator, like how efficient and how strong the proposition of a product really is. Gross margins is super important. Payback on marketing, churn, contraction, expansion, all that. And now in the crisis, as Pascal said, burn rate is very important, because at least you need to extend the runway, because you don't know. Does it really take now 2 quarters until the world is going back to normal, or is it like 6 to 8 quarters? And will the financial markets be open and remain open? Nobody knows. So you have to cut costs, postpone payments, renegotiate your contracts with like the cloud vendors, and so on and so forth. So this is one thing. But on the other hand, we look at net retention. For us, what we typically see now is that in the crisis, which was mainly in April, that new business went down. Churn was not really the big problem. It's more like contraction. So people were downselling. We'll say, look, we have like 500 seats here. Right now, we probably only need 50. And can we please ask to pay later? We don't have the money yet, so we want to pay. So it's like a cash flow problem and more a contraction. The good thing about contraction is most likely these customers will come back. So really look at what's the problem. Is it really churn? Are people walking away from your company, or are they just reducing because they do not have the capacity, they don't need it? And then if new business went down, then the question is, what do your existing customers do? Is there how is net retention? Like your existing customers, how do they behave? Do they still sell up? If so, understand why and which customers are they? And then try to focus on these customer groups and this industry, because most likely they do not have the problem and they remain active and want to invest. So these are things that we look at. And the bottom line is, there is a lot of businesses which suffer pretty hard, but some less. But in general, we see it in Europe and also in the S&P sector. The real strong companies, they are coming back. Since 3 weeks, basically every company in the portfolio since 3 weeks is growing again. So they are not back at the level they have been before, but they are growing. And if you have a strong product, good product market fit, you will be able to keep your customers. You will be able to cut costs to survive and to raise more funds. Because if you're a leading provider in any industry of some kind of service or product, then you will win. It's just you need to go all in and do the right things. Don't be shy of taking difficult decisions. And then if the KPIs show, investors, there are many investors, and most of them are still open for business. They know, they will see, and they will know how to interpret the data, even though the revenue goes south.
That's great, Thomas. And I think we're running close to the end of our time. So maybe what would be interesting is to have an open-ended final tip that each of you could provide to a founder that's watching us in terms of how to face this current moment. Maybe we could get started with you, Michael. Could you share any insights? Any suggestions?
That crisis is when greatness gets born. So it's super hard, but it is also a time of amazing opportunities. It is an amazing opportunity to really force a sort of an energy and a coherence in your team and a shared sense of mission. It is an opportunity to potentially pick up some really good people in the outside world. It's a good moment to see who is really helping you and who is really there for you. And then sort of, everyone else is under pressure too. And so when the smoke starts clearing, that's when opportunities kind of start forming again.
Yeah, necessity is the mother of all invention, as they say, right?
Yeah,
makes a lot of sense.
It is because we're super excited about chaos and energy and renewal, right? So otherwise, we'd all be at banks.
Yeah, it'll be horrible to waste a crisis. Let's hopefully learn as a society and as entrepreneurs as well. Pascal, any thoughts? Pascal.
I was muted. So yeah, something maybe a little more practical. So we live in a world of Zoom or Hopin. So we live in a media world right now, and every discussion happen online. So just kind of like kept ramping up your that skills, maybe adapting the pitch deck to that medium, meaning that maybe you can focus for an hour the way you focus in person, the way you would focus through screen. So maybe clear decks, clear points, maybe shortening a little bit the deck to kind of allow the VC to digest things remotely better. And I think to that point, I think a lot of VCs are getting comfortable building their due diligence without meeting a team in person, which is a big transition, which allows the entrepreneur to tap a broader range of VCs and think about VCs are in the US or VCs that are in Latin America that might decide that they want to invest in you without even meeting you, because we were talking about the fact the world is flat right now, and if you have some proxy if the VC has proxies in the country where you live that can use that proxy to kind of do some diligence on you personally, you could potentially land a check from a fund you would never thought you could land a check from before.
That's fantastic. Thanks so much, Pascal. Any suggestions, Thomas, for the entrepreneurs watching us?
It again.
Any final suggestions for entrepreneurs? Closing thoughts for entrepreneurs that are watching us?
Yeah, but I think we are running out of time. So there is so many, so much. So
we
one
could go
is,
on here.
Just go all in. So the more you want it, the more you get help. And there are many. So sometimes many people start a company because it's cool to start a company, and these are the guys investors don't really like. So, but there are so many people who really solve problems and have to do it, and they deserve all the help we can give to them. And it's the same in the crisis. So it is hard, and it's also very unfair. Now you build your company, and you get diluted. You have to raise more capital, and so on and so forth. You come to a certain level of valuation, and then something like COVID kicks in, and then you get a discount of 20-30% of the value that you have created with your sweat and your sleepless nights over the last years. And this is simply unfair, but there is no one to blame. So it's just you are the captain. And it is tough, but there are many VCs who know exactly the pain. And I would encourage you, never give up. Try to look at your numbers, try to build just as the most awesome company in the world, and efficiency, build an efficient engine, and then go and pitch numbers. Numbers is all that counts. The later you are, it's all about numbers, and then it's getting easier and easier. Never forget that. As hard as it feels, the numbers and the rounds, and there will be guys that will help you, and then you will be able to build your company and change the world. So yeah, a little bit pathetic, but in the end, it is worth spending all that pain. It will pay back, and we are all investors. We are there to help you. And it's a pleasure if we see someone who's burning for his idea and who's burning for his company. We are all very happy to really give a little bit of support and really try to make life a little bit easier for you. So yeah, just go all in and make it.
The party is still going on, right, Thomas? So
yeah,
With that, we'd like to thank the panelists. It's been a pleasure. Again, we had here on stage Thomas Bruce from the TCP, Pascal from Storm Ventures, Michiel from North Zone, myself, my name is Patrick from Alexia Ventures and venture partner at DGF. And thank you so much for SaaS Talk. I think it's incredibly important at this moment for us to pick the brains of everybody that's living through this and really try to support the founders, which are really in the most sensitive moments. But as I think as all of us here in the panel and most of the other participants in this event, which is fantastic, we're here to try to, as a support network for the challenge of making founders accomplish their dreams. So thank you very much for the participation, the SaaS Talk, and we look forward to seeing you hopefully in the networking sessions here, and hopefully we'll do some deals together. Thanks.
Thank you.
Patrick,
Take care. Bye-bye, Pascal, Michiel, Thomas.
bye-bye, everyone.